Here is something that will quietly bother you for the rest of the day. Two people, same job, same salary, same city. They start investing on the same day. One of them reaches $100,000 in their portfolio after 6 years of disciplined, boring, consistent saving. The other one never gets there. Not because of a disaster, not because of a medical bill or a divorce or a market crash. They just never get there. They stay stuck somewhere between $30,000 and $60,000 for years, moving but never arriving. And the wild part? The difference between those two people is rarely income, it is rarely discipline, it is rarely even intelligence. It is something else entirely, something the financial industry almost never explains clearly, because if they did, a lot of their business models would stop making sense. Today, we are going to talk about the $100,000 threshold, why crossing it changes the math completely, why the journey to it feels brutally slow, and why, once you are past it, the entire game shifts in a way that most people only understand in hindsight. Stay with me, because this is not about motivation. This is about mechanism. Let us be clear about something upfront. The number itself is not magic. $100,000 does not unlock a secret bank vault. No alarm goes off, nobody hands you a certificate. But the math around that number behaves differently than the math below it. Significantly differently. And in a financial environment where inflation has been reshaping purchasing power, where interest rates have spent years doing things economists spent decades calling impossible, and where more people are investing earlier than any previous generation, understanding the mechanics of wealth accumulation has never mattered more. Because here's the uncomfortable context. The majority of people who start investing give up. Not dramatically. They don't close their accounts in a rage. They just slow down. They get distracted. They check their balance after 8 months and see $4,200 and think, consciously or not, this is not working. And they redirect that money towards something that feels more real. A vacation, a car upgrade, a better apartment. They're not wrong to feel that way. They're just misunderstanding the shape of what they signed up for. Wealth does not grow linearly, and that mismatch between expectation and reality is where most financial futures quietly die. Let us talk about compound interest. And before you zone out because you have heard this before, I want to tell you something. Most explanations of compounding are technically correct and psychologically useless. They show you a chart. The chart has a hockey stick shape. See, they say, it goes up slowly at first and then very fast at the end. And you nod. And then you go home and your balance goes up by $47 in a month and you feel nothing like that chart. So, let us do it differently. Let us use a real number. You invest $1,000 per month. You earn an average annual return of 8%. At the end of year 1, you have roughly $12,500. After fees, taxes on any distributions, the occasional imperfect month, call it $12,000. You worked, you saved, you sacrificed, and you have $12,000. Year 2, same thing, maybe $25,000 now. You are 2 years in, you have given up restaurant nights and weekend trips, and you have $25,000. Year 4, around $58,000. Year 5, around $73,000. Year 6, you cross $100,000. 6 years. For most people, 6 years of consistent, unglamorous saving. But here's where the shape changes. In year 7, your $100,000 portfolio, even if you stopped contributing entirely, generates roughly $8,000 in returns at that same 8% average. That's 8 months of your $1,000 contributions, working without you working, just sitting there, compounding. By year 10, if you kept contributing, you are close to $185,000. Your money is now generating more per year than many people save in a year. By year 15, around $350,000. The returns alone at that point are roughly $28,000 annually. That's more than the median monthly take-home pay of a full-time worker in many parts of the country. The hockey stick is real. The problem is you have to survive the handle to reach the blade. Now, here's the part nobody puts in their glossy retirement planning brochure. The early years are not just slow, they are actively hostile to staying the course. And this is not a psychological weakness, it's a rational response to a system that is genuinely hard in ways people underestimate. First, opportunity cost is most painful before $100,000. When you have $20,000 invested and you need a new transmission for your car, that $2,000 repair represents 10% of your entire portfolio. It's enormous. It's visible. You feel it. You might even pull it from your investment account, which resets your progress and costs you compounding you will never recover. By contrast, when you have $400,000 and you need a $2,000 repair, it's 0.5% of your portfolio. It barely registers. You cover it from cash flow and move on. Second, volatility feels catastrophically different early on. A 20% market drawdown on $20,000 means you lost $4,000. That's a few months of hard saving gone in weeks. It feels like a punishment. It feels like evidence that the whole thing was a mistake. A 20% drawdown on $400,000 is an $80,000 loss on paper. That's obviously larger in absolute terms, but the person with $400,000 has usually lived through corrections before. They understand the pattern. They've seen the recovery. Their identity as an investor has been stress tested. They are far less likely to sell. Third, the compounding has not kicked in yet. Before $100,000, most of your growth comes from you. Your contributions, your labor, your sacrifice. The market is helping, but you're doing most of the lifting. This means every disruption, a job loss, a health event, a month where you just spent more than you planned, has an outsized impact. You're the engine, and engines get tired. After $100,000, the market starts to share the load in a meaningful way. You are no longer alone. There's a concept in physics called escape velocity. It is the speed you need to reach to break free from a planet's gravitational pull. Below that speed, gravity wins every time. Above it, you are free. $100,000 in invested assets is not a perfect analogy, but it rhymes. Below it, the gravitational pull of ordinary life expenses, emergencies, temptations, and the sheer psychological weight of slow progress is enormous. Many people never achieve escape velocity. They orbit. They save, they spend, they save, they spend. The balance drifts upward slowly, if at all. But once you are above a certain threshold, the math starts working in your favor in a compounding way that is hard to articulate until you experience it. Returns beget returns. The gap between your contributions and your portfolio's self-generated growth narrows, then inverts. Here's what that looks like practically. At $100,000, assuming an 8% average annual return, your money generates $8,000 a year. At $200,000, it generates $16,000. At $500,000, it generates $40,000. At $1 million, it generates $80,000. At some point on that curve, your portfolio is earning more per year than you are saving, and then more per year than you earn from your job. And at that point, the conversation about your financial future changes completely. Not because you are rich necessarily, but because you are no longer entirely dependent on your own labor for financial progress. That is not a motivational concept. It is arithmetic. Let us talk about why people do not get there, and let's be honest about it. The standard advice is earn more, spend less, invest the difference. That is true. It is also nearly useless without context. The median American household income is roughly $75,000 to $80,000 a year. After taxes, you're looking at somewhere around $55,000 to $60,000 in take-home pay, depending on your state. Housing, food, transportation, healthcare, insurance. By the time you account for the actual cost of a functional modern life, many households are left with $500 to $1,500 per month that is genuinely discretionary. At $1,000 per month invested with an 8% average return, it takes roughly 6 years to reach $100,000. At $500 per month, it takes closer to 9 or 10 years. 9 years. of consistent investing, through recessions, through job changes, through the years where the market drops 30% and the news tells you the world is ending, through the years where everything is fine and you just get bored. And here is the quiet irony at the center of all of this. The people who most need compound growth to work, people with lower incomes, people who started later, people who cannot absorb financial shocks without touching their investments, are the exact people who face the highest friction getting past $100,000. The math favors those who are already buffered. This is not a conspiracy. It is just how compounding works when you layer it on top of an unequal starting field. The same mechanism that eventually makes wealth self-sustaining also makes it slow and fragile in the early stages, and early stages are where most people live. Now, the financial content industry has a very particular way of discussing all of this, and it's worth naming it. The dominant narrative goes something like this: invest early, invest consistently, let compound interest do the work, and you'll retire with millions. And that narrative is not wrong. It's just edited. What it omits is the emotional and practical difficulty of surviving the accumulation phase intact, the decade-long slog before the math becomes viscerally rewarding. The fact that for many people, the math alone is not enough to sustain the behavior, that people need social reinforcement, a sense of visible progress, tangible milestones, or genuine increases in income to make it to the other side. The financial content industry has monetized optimism. Podcasts, YouTube channels, books, courses, they're all fundamentally in the business of making you feel like it's more achievable than it is, because that feeling is what keeps you listening, buying, and clicking. Not because it's dishonest necessarily, but because hope sells, and nuance is complicated. The result is a generation of people who intellectually understand compound interest, genuinely want to invest, and still chronically undersave. Not because they're lazy, because they signed up for something whose rewards are backloaded in a world that punishes delayed gratification socially, culturally, and sometimes financially. Understanding this does not make the math change, but it does change how you should think about the difficulty. The friction is not a personal failure. It is a structural feature. So what actually moves the needle? What compresses the timeline in ways that are realistic, not fantasy? 3 levers, only 3, and they are not equally powerful. The first lever is contribution rate. This is the one everyone talks about, and it matters enormously in the early years, precisely because your money is not yet carrying its weight. Getting from $1,000 per month to $1,500 per month in contributions does not sound dramatic, but it compresses a 6-year timeline by roughly a year and a half. That is 18 months of compounding you moved forward. The earlier you do it, the more those 18 months are worth. The second lever is return optimization. This is where most personal finance advice goes completely off the rails. The internet will tell you to find investments that return 12%, 15%, 20% annually, and some do in some years, but average annual returns are what matter, and chasing higher returns almost always involves accepting higher volatility, which is the one thing most wealth builders in the accumulation phase cannot afford, emotionally or practically. A broadly diversified index fund returning 8% on average is not glamorous. It is also not wrong. The hidden variable inside return optimization is fees. A 1% annual management fee on a $100,000 portfolio costs you $1,000 a year today. It costs you vastly more in 30 years because of the compounding that fee stole. Vanguard, Fidelity, Schwab, they all offer institutional-grade index funds with expense ratios under 0.1%. This is one of the highest leverage decisions you can make, and it requires no skill whatsoever. The third lever is income, and this is the one that makes the other two actually functional for most people. There is a ceiling on how much you can cut expenses. There is no ceiling on income. A $15,000 raise that gets redirected entirely to investments does not just move the needle, it bends the curve. 2 people with the same investment strategy but a $20,000 income difference will arrive at $100,000 years apart, not months, years. This is not advice to grind yourself into the ground. It is an acknowledgement that for most households, the most powerful financial tool is not investment strategy. It is earning capacity. Zoom out for a second. because there is something larger happening here that is worth sitting with. We are living through a moment in economic history where the asset-owning class and the wage-earning class are diverging in ways that make the $100,000 threshold more significant, not less. The stock market over the last 4 decades has generated extraordinary returns. Real estate has appreciated dramatically in most major urban areas. Interest rates for a long period essentially punished savers and rewarded borrowers and asset owners simultaneously. The people who were already past the threshold, already in the compounding zone, captured most of those gains because they had the exposure. They were in the game. The people who were not there yet were watching from the outside, working harder for wages that, in real inflation-adjusted terms, were barely moving. This is what wealth concentration looks like from the inside. Not a conspiracy, not even deliberate design, just the mathematics of compounding applied over decades to an unequal starting field in an environment that was unusually favorable to financial assets. Which means the stakes of getting past $100,000, or frankly of getting to any meaningful invested asset base, are higher than they have ever been in modern history. Not because the number unlocks anything magical, but because the window between being in the compounding game and not being in it has financial and social implications that compound just as relentlessly as the math does. So here's where we land. The $100,000 threshold is real. Not as a magic number, as a mechanical inflection point where the math shifts, where your money begins to contribute meaningfully to its own growth, where the effort-to-reward ratio of investing starts to feel like it makes sense for the first time. Getting there is genuinely hard, harder than most content will tell you because most content has a business interest in you feeling optimistic rather than accurate. The friction is structural. The timeline is long, the volatility is real, and it hits hardest when your balance is smallest. But the mechanism is not complicated. It's not secret. It's not gate-kept behind a credential or a net worth requirement. It is just math applied patiently at the highest contribution rate your real life can sustain, with returns that are good enough and fees that are low enough for long enough that the curve bends in your favor. The uncomfortable question, the one that doesn't really have a clean answer, is this. In an economy where wages for most people have barely kept pace with inflation for decades, where housing costs have structurally outpaced income growth in most major cities, where one health crisis can zero out years of progress, how many people are realistically positioned to stay in the game long enough for the math to save them? That's not a rhetorical question designed to make you feel hopeless, it's an honest one. Because the answer depends on decisions being made right now, by you, by policymakers, by employers, by a financial industry that profits enormously from both your participation and your confusion. The $100,000 threshold is achievable for more people than reach it, and understanding exactly why the road is hard is the first real step towards not letting that road beat you.